Welcome everybody to the beginning of fall that feels like the summer, feels like August. Today, I have a couple of things that I want to talk about in particular, but I think to start off, and I don't have my agenda in front of me now, but I just so that Stacy, okay, Mike's here. Stacy gets to hear the words of wisdom from Jim. I think what we'll do is we'll start out with Jim's update and review of the current situation. Good luck, Jim. Thank you.
Yeah. All right. Well, I'll try and keep my comments brief, but I guess basically as we all know, we're seeing the highest inflation since the 1980s. I think the Fed started late. They're playing catch up, although monthly inflation seems to be slowing some. We're looking at Social Security cost of living adjustments, maybe 8.5%, which is really, after years of just no increases, it's quite amazing. The bond market, in the last year, the 10-year has gone from 154 to 395 this morning. The 2-year's gone from 0.36 to 4.26, and the 1-year's gone from 10 basis points to 4.10 today. So we've got a really flat curve predicting a recession. So the inversion of the 10-year to 2-year Treasury is like 83% accurate at predicting recessions with a 16-month lead time, and the 10-1 negative spread is nearly 100% accurate in predicting it 12 months in advance. So as we've heard people predicting, 12 to 18 months, we're going to have a recession. I believe that's true. We got here to this inflation point through a lot of things. The stimulus money, lots of money flowing in, maybe too fast and too long. We cut domestic oil production, and then of course supply chain interruptions with China and Ukraine and Russia is pushing prices up, fuel, fertilizer. Bank deposits swelled in the last 2.5 years to record levels. They finally started to decline. So nationally, bank deposits over the last couple of quarters have decreased. So money's flowing back out into other markets, I guess, or let's see. So the flight to safety and the dollar's really strong nationally, or worldwide rather, and so that helps our purchasing power, but it also hurts our exporters. And as I'm hearing that hazelnut prices are half of what they expected, that's part of it. The supply chain and the strong dollar makes our hazelnuts more expensive. The pandemic really drove a lot of purchasing, a lot of housing. Everyone needed a new house, a remote to work house, or a short-term rental. We're starting to see that decline as mortgage rates are approaching 7% now, so nearly double where they were, more than double they were a year ago. And so I guess the refi boom's down when we see the stock market is off considerably. And then this inflation, wage inflation isn't going away. And, you're seeing a lot of inflation in food and packaged goods. I was reading a piece from one of our investment advisors, packaged goods, the size of the package is decreasing, which is equating to a 20 or 25% increase in packaged food costs. So, but where do we go from here? I think the median forecast is for the Fed funds, which is at 325 today, to peak at 450 or so, but some forecasts have it at 5.25, so another 2 percentage points higher than we are today. I believe the market's predicting that it's going to be overdone. We will go into recession. The Fed will reverse course, and that's hence why we have this flat yield curve where we have higher short-term rates and then long-term rates. That 2 years from now we expect rates to be receding again. So if that makes sense, and that's all I have. So let me know if there's anything you'd like any of you'd like to add to that. But
So at what point, Jim, do the banks start increasing the rates that they pay to the depositor?
hopefully never. No. What happened, Chris, is so like in our model, we'd like to have a 3% margin over our
Right.
cost of funds.
Sure.
So last year, we did $100 million in mortgages at less than 3%. So we don't even have a 3% margin in our mortgage.
Okay.
So as in all banks are in that condition, or I shouldn't say all, most are in that condition. So our earning yields need to come up sufficient that it pulls that spread. And once that spread starts moving, then we'll start raising deposit rates, our cost of funds. You're starting to see some CD specials pop up around primarily credit unions and some banks doing some short-term CD specials like 11 to 25 months or maybe even 36 months. So again, kind of predicting that they don't want money longer than that because they think it's going to be cheaper 3 years from now, if that makes sense.
Yeah, it does. Yeah. I asked because US Bank recently, I have an appointment with them this week because they said, oh, we've got great CD rates now and we want to talk to you. And I thought, well, let's see. But so apparently they're in need of funds again. And
that could be, I'm not sure. I think their US might have a special like at 150 or something like that, 1.50 or 1 year, 11 months.
Yeah. Well, thank you. Does anybody have any more questions about what Jim has told us or anything?
Or your own observations. Maybe you have something to add. Welcome.
Yes, please do. Stacy, are you weathering the storm fairly well over there in your company with your?
Yeah, thanks for asking, Chris. Yeah, no, we are, as a consulting firm, a lot of our clients pay us retainer fees. There is a portion of our business, so the retainer fees are sort of set and they don't fluctuate with market movements. There is a percentage of our clients that pay us market rates, a basis point fee based upon the assets that we're advising on. And so when stock markets go down the way they have, and as we all know, even the fixed income markets have not so much what the Oregon Treasury Group is invested in here because that's more stable. But if you're out longer duration in the fixed income area, you've seen some fairly significant negative returns this year as well. Just given how rates have risen, as Jim mentioned. So, asset values for all sorts of different assets have come down this year. And, really the only sectors that have been performing well have been cash, and then also some of the energy and commodity sectors. And so that has had a smaller impact on our business. But I think the more important thing is just kind of weathering through with and talking to clients who have investments that have been more challenged. But I'm glad with this particular investment program being very stable. You haven't seen that sort of drawdown.
Mm-hmm. Yeah. Kevin, are your clients weathering the storm? Are they not panicking at this point?
I mean, it's it's a mix. Most of our clients have been with us for long enough that we've gone through some market cycles. So, but yeah, we definitely have been changing things up. We're doing a lot of, 6-month T-bill kind of ladders for people, just because there's some kind of like Jim was saying too. It seems like the bond market is, still predicting that within a couple years or so, things are going to kind of start to normalize. So, we've been trying to keep things short term on the fixed income side, but, try to keep things easy for people, but it's not always easy.
Yeah. And Katie, I don't know if you're actively, I know you're a tax accountant and this is starting to be tax season already. Are you involved in active management at this point?
No. At this point, October 17th is the deadline, so everyone is trying to do the last minute prep, get me the documents, and every single person complaining, like I had a client yesterday that basically said there was a hit of 60% reduction in his portfolio.
Yeah.
So, and he was really concerned and trying to like plan how he's going to manage the fact that he will have way less going forward than he expected. And like, I don't know how long it's going to take us to get back to whatever we were as far as the
Yeah.
level. So it's, everyone is talking about it and getting really upset. So,
Yeah.
and all the software packages and everything else, you know, in some accounting software packages, we have increases of 50% from Intuit, which is absolutely crazy.
Yeah. 50%.
Mm-hmm.
Wow. Yeah. So, you know, in general, I just wanted to kind of bring us all in on this because we're all swimming in the same pond, and I think that, you know, for the county, you know, because it is so low risk, we have not endured any catastrophes because we buy and hold. But I was looking this morning just to get a feel. I was looking at one of the leading bond funds that buys government bonds, and they are down 11.5% since January. And this would be a very, very conservative fund. And we are down. I mean, if we were to sell our portfolio, our unrealized loss is 6%. So I guess that's good. It doesn't really matter because we're not going to sell, but it's still nice to get a feel for that difference. And of course, the problem with the commercial bond fund is they do buy and sell, and so their losses are somewhat permanent compared to ours. Not completely. I know they'll recoup, but it's what I was saying when we were in LGIF, if you remember that, which was a mutual fund. And when I was at the Treasurers Conference recently, there isn't anybody that's in that fund, and that's good because they've had some significant losses. So I'm glad we pulled out when we were ahead. So moving on, we have and once again, I apologize that I sent out another packet yesterday. I looked at the reports that I get from Clearwater, and they're great, but there's still different ways that we look at things that I wanted to have included in our report so that it addressed our goals specifically. So that's why I added some pages that are different. So we will go right into that. Oh, and I do have, oh, that's interesting. Okay. That's for August. You know, they did do something weird. Now I'll have to go back. Sorry, I have to go back and get my report because it appears to not there. I get everything all set up perfect, and then it's not. So you can all look at my hard drive now. Fascinating. Okay, can you all see that now? Can you see that?
Yes, Chris, I
Okay.
can see it. It's kind of half screen. I don't know if that's other people. I can see the agenda, and then I can also see your background that says Office of the Treasurer.
Okay, yes, I will make this bigger. So they're right over my. How's that? Better? Yes, okay. So I set out the minutes, and they're pretty short. So do I have someone to motion that we approve the minutes, please?
I motion.
I'll move approval.
Okay, and all in favor?
Aye.
Aye. Any questions?
Aye.
I,
Thank you. So are there any questions about the minutes? Is there anything at all that came up that was surprising? I don't, I'm not a secretary. And so I do the best I can, but I don't want to spend days doing it. So here we are. This is the rate trends over the last 2 years. And to give you an idea of what we've been talking about, you can see in the chart that inflation, of course, has gone way up over this period. And fortunately for us, the LGIP has gone up quite nicely. And, you know, which I think people over there do a great job. I think too. They did raise the rate. Now it's 2.2. And now that does not mean that they're not also experiencing unrealized gains, but that they're able to pay us at least a good rate. And then this interesting thing, our bonds are actually earning 4.37% if you look at the market value of our portfolio. And so one of the questions that I have, this was never shown on the Zion statement, but one of the questions I have, it's kind of philosophical, is do you, which is why I put our actual book return is only 1.45, but we are discounted down so that we have our bonds have devalued significantly, so that if you were to look at our 34 million and what we're getting, we're earning 4.37%, which is just the market adjusting our portfolio, so that if we were to sell the whole portfolio, whoever bought it would realize a return of 4.37. I don't know if that confuses the issue or if it's helpful. What do you guys think? Does
I think, Chris, that as you said, would be the current yield of the portfolio if you sold it.
right?
So, I mean, it does represent a significant unrealized loss position that we're in.
Right,
which
right, yeah.
We're at the same, at First Federal, we have a significant unrealized loss in our portfolio as well.
Yeah,
What
yeah,
happens? It'll
Yeah,
creep
so
up
I-
over time.
yeah. 'Cause it's me for a loop. And I thought, well, maybe we should track this too, because this is in fact, what is the current rate, market rate on our portfolio as opposed to our book rate. And I found that interesting. And so it is about what the rates are for a portfolio with the average maturity that we have, because we have a quality portfolio. The next thing, this was a real challenge for me, is this is our actual earnings over the last since 2017 for each year, and then I had to come up with an estimate for this fiscal year. And if I were to take a straight 2% on our average balances, it would be more like $1 million. I can't remember, $1.1 million, $1.2 million. So we will have some significant increase in earnings. That's the positive part of this overall trend of rates going up. But because we like to be conservative, and I just did my best ballpark, and I'm comfortable saying that we'll only earn 930,000 this year, and we'll be pleasantly surprised when it actually comes up to, closer to $1.2 million. And as we get farther along into the budget process, we'll have another quarter under our belt, and we'll have a better idea. But it's beneficial for the county at this point. Things are, given that we have inflation to deal with, this is a very nice thing to deal with, that we haven't had earnings this high since 2019-20 year. And we were seeing that trend go down ever since I took over. So it's like, oh, good, we get to have it go up. Then the other good news is that LGIP has increased the limitation from 52 million to almost 57 million that we can hold in LGIP. And, I'm happy about that. And as tax season comes up and we start getting tons of money in, that'll be really nice to be able to get more in there and earning a good rate of return while it transitions to other places. So that's very good news. And then this is like what I used to do, and I felt the need to do this chart, and so this is just a snapshot of where we were at the end of October, and what our bond mix is, and where we're getting our interest, how much interest did we get last quarter in each area, and once again the benchmark rates, and it's kind of a summary of where we are. Our average credit rating, of course, is very solid now because I'm only buying treasuries and agencies. So that will, both the credit rating really can't go up from where it is, but it'll stay at AA. Our maturity, years to effective maturity, is 2.27. I'm happy with that. That's about where we should be, but I will not be buying longer term anything. I agree with Kevin that what we need to do is to put our money in very short term investments until things stabilize. At the time that we did this report, and Jim, you warned me about this. We actually have more bonds in investments, 66%, than our investment allowance of 65%. That was a surprise to me because we were tracking along quite nicely. One of the disadvantages, and I don't want to change this, one of the disadvantages of having me kind of siloed off from finance is that I don't always have the sense of what cash is going out for each period of time. And so quite a bit of cash has gone out from the county in the last couple of months. And it brought us the proportion just a little bit different at 66%. In the future, and I had kind of mentally thought, well, 36 million is about where we should be in the portfolio. And then I'm going to say in the future that we probably should be no higher than 32 million for the problem that arises towards the end of the year. Now we can be over at times when we have all this tax money and operating funds that have built up. But what happened, and what is important for me to watch closely, is that a lot of our securities mature at the time of the year when we're cash rich. That's not helpful. So what I need to do is, as I go along, is to get more securities maturing in July, August, September, so that it provides the cash that we need. Does that all make sense to everybody? What's happened there? But Jim, you told me that. Yeah, I remember you saying, just remember when the portfolio goes down, and I said, oh yeah, I got that handled. Well, it went down farther than I had anticipated, although it's not a problem in terms of the overall financial health of the county. County's fine. They're not overspending. It was just a kind of a rookie error, and my maturities coming out at the right time. And then this is the quarterly report produced by Clearwater. Says a lot of the same things. There's really no surprises here. We did have 1 million in bonds mature, or in the sell, the 100, that's actually a call. We had one bond called. And then I did buy over the quarter 1.5 million in securities. And all relatively short term. So the going along here, our duration rate, we still have some bonds that are in the 4 or 5 year category, and 5% of our portfolio is there. And given what we're looking at now in terms of rates, it drags down our overall interest rate because they're at very low rates. And then, as I said, our credit rating is great. We still have Oracle, which is going to actually mature this coming quarter. So that's our BBB. The corporates are 5% of our portfolio now, and I anticipate those will run off very slowly we had bonds at one point that were 7 years in maturity, and I sold those off, but I kept anything that was 5 or less. And so that's going to roll off as well. So we have this big clump in terms of maturity that is in the 2 to 3 year. We've got that 12 million there. And so that is, excuse that has to even out. Now, one of the challenges when I was buying some of these bonds in here is that in the shorter term, it was like 10 basis points, 20 basis points. And in order to get any kind of yield at all, I was buying in the 2 to 3 year. Well, now this is bigger than it should be, but it will roll down. And over time, as I add to the portfolio, it will be, especially because if I had cash right now, I could buy a lot of short-term bonds, and that would be great. Here's the actual trading activity. You can see that I bought these 3 bonds: Federal Home Loan, Federal Farm Credit, and then these are the bonds that matured, and they are leftovers, remnants from a previous period where they're smaller amounts, and I'll be really happy when we get these smaller amounts out. And this is a cash flow analysis in my rudimentary way that I try to do to see the cash flow that will be coming back to the county by month. And you can see that it's not a lot. We don't have a lot of bonds maturing for the remainder of the year. And then in January, we have more, and we'll get an inflow of 985. Now, we won't care in January about that, but we will get that. So it goes through, and I apologize. This is my stab at trying to look at this, and because actually Clearwater does not provide a lot list, which of course I could look at, but it doesn't summarize it quite the way I would like to see it. Plus, they also assumed they can only start from June, so we don't have any kind of history, which I would like to look at. So that is that. And then this is our lot report. This is everything that we have in the portfolio. And it's alphabetical, so there's no particular reasoning behind the order other than alphabetical. So if you want to look at that, you certainly can. And you can see some of these bonds, if we were to sell them, here's a 45,000 unrealized loss that we're sitting on for that. And that's not going to mature until September of 2025. So I think this is probably a couple of things that, because I have never ridden through, and maybe nobody has ridden through this kind of dramatic change in interest in such a short period of time. It's been shocking to be buying bonds at that I thought were exceedingly good at 1.5% in July, and have that same bond trade for 4.5% now. It's pretty amazing. But we're fine. We're getting good income. We're not going to experience any losses, and our credit is going up. And let's see what is. Oh, and this was just another chart showing inflation that Stifel sent out today, and that you've seen. So that's it. Any questions, comments? You guys are pretty quiet.
Chris, I have a question. None of the reports on the bonds there, whether the holdings or the purchases and maturities have the coupon. It'd be, if that's available, it'd be interesting to see the
Yes,
coupons
yes.
on those.
Yes, I should have shared that one. I actually have to go manually in and create a new column because, and I can do that easily. Clearwater does not do that in their standard report. They, in an effort to make it. So I can change that and then save that format for future. Would you like me to send that out to you after the meeting as well?
No, I don't, not for me. We can look at it next quarter.
Okay, all right.
Thank you.
Yes, thank you. I can show you. Let's see. I just don't want to turn you guys off when I'm. Okay, you're there. So what I can show you is I can go to Google. It's kind of fun anyway for you to see what this platform looks like. And if I go to Clearwater. So here's the report from the beginning of October, same report that you saw. If I go to accounting, and here's the lot report that I just sent out, and what I can do is I can go in and add a column. Right. And there it is. Voila. There's everything you want. So I could send this out. And so then what I can do, because this has the ability for a wealth of information that I can add and subtract to this at any time that I want. And I can change the so now it's going by coupon, so you can see. So I could sort any kind of way. So this is, since you guys haven't seen it yet, this might be kind of interesting to you. We also have the clients. Yeah, I'll leave that. So we have 15 parameters for compliance that are in the software for us. And so this is where I would look and I would find out if there was a compliance issue. And so we don't have any right now, but if I had one, it would show up here. Not only would it show up, but it would give me an opportunity to address that and explain that. And then that's a permanent record. So that's actually quite nice. We have the credit rating. And we've seen this now. See, this is, those are the two companies that are A minus that are in our portfolio. And I'm not really concerned about IBM or Southern California Edison, but they are below what we should be. And then this is all that we have in the A plus category. And we can buy municipal bonds that are A or higher. So this is in conformance, and this is going out, but it is conforming. These 4 companies here are below what we would like to see, but there's no reason to sell them. So, and then you go into all the higher rated. We do have some corporates that are higher rated. And anything else anybody wants to see on this, as long as we've got it open? It's fun to play with. It's really a wealth of information. And this is where Mike's still here. Mike gets information that he needs for his reporting from these. Which one do you use, Mike?
I think I use what's called the GASB.
Oh.
Go to the gap.
Okay, Gap.
I have it written down because I don't memorize these things very well. I forget which one it is, but it's basically a lot report, and it gives me the outstanding unamortized bond premium discount. Also gives me accrued interest. So each month we basically record the changes in those. So it's been great. For the first time since I've been here, we are now actually showing interest and bond revenue on an accrual basis. In a real gap basis versus just cash basis. So it's working out great.
Okay, here's the accretion, blah, blah, blah. Yeah. So it's a wealth of information. It can't give me everything that I want because we still have the issue that the LGIP is not included, and we should be able to include it. And so I'm going to tackle that this quarter when Mike and I were at the Treasurers Conference. There was a couple of people who said that they have been able to do that. So we know that Clearwater can do it. It's just that we've been dealing with people who really don't have the background that we need. So that will make it a lot easier. So then the only thing that will not be included in this would be the US bank account, which is easy enough to add back in. Any other questions about that? So if there is anything, and if anybody wants to have access to this, I can give some level of access to people so that they can look at this as well. So just let me know if you would like that. It's probably a lot more in the weeds than anybody on the committee would like to have, but it's really great. And I look at, every day I go through and do a little short equivalent of quarterly analysis as to where we're going. And this is, absolutely live in terms of we have the day before's valuations on everything that we have. So anything else? I would like to get this so I'm no longer Well, they've changed it on me. I can't find where you guys have to sit here and look at this. Well, I can't seem to find a way to stop sharing my screen. Anybody have any suggestions? This looks different.
You should have a toolbar down at the bottom of the screen if you hover over it to where you have the chat participants and then you have where the share screen. And I think,
You know,
Oh,
yeah,
yeah.
and I don't have that now because they changed it. That's the thing. It's they've got this new bar up above that what about try that?
Can you go into exit full screen and then that
Ah.
bar that Ken is talking about will
Yeah,
pop
see, now
up?
this comes back. Okay, the bar's down where it should be. So thank you, Mary. Commissioner. Thank you, Commissioner. So okay,
Well, anyone who takes advice on computer stuff from me is obviously isn't wise.
oh, thank
Because
you,
I never
Mary.
know what I'm doing.
Compliment. Yeah, I'm actually pretty good with computers, but I'm I have to say I get a little rattled when things are live. I'm a very plodding kind of person. I like things at my own pace. And maybe that's a sign of age. It's like, let's just keep this mellow. Okay, this is all that I had planned on covering. Is there anything else for the group that we should talk about? I appreciate you all being here. And the one thing that I am going to look at so that I have is I think I'm going to need to move the meetings a week out so that I have more time to work on what I want to present, because it depends on when the first of the month falls. Sometimes I don't get my information until the 5th or the 6th, and then sometimes I'm supposed to have this done a week. Well, my personal goal is to have it done a week before the meeting so that everybody gets it in advance. And so it's a little tight. And I know it doesn't seem like it should be, but it is. But I'll let you know. I'm going to look at the next year, 2023, and where all the dates fall and see what works. And then I'll let you know if we change that. I'm kind of thinking we will. I've thought about doing a meeting in person, but one of the challenges with that is that I like having recordings of these meetings, and I don't know where I could do that and have that work for us, because the conference room, I don't think, Commissioner, do you know, is the conference room equipped with an ability to do a Zoom or a Teams meeting or
it is.
It
I
is?
can speak to that. Yeah, we've used it for that. And so, keeping in mind that with the changes on the public meetings laws, that we have to be able to accommodate hybrid meetings for public meetings. So the ability to have both remote participation and in person, if we do an in person, but that room is set up. It has a camera, it has a TV.
Okay.
And a lot of times what we'll do is we'll just run a laptop and typically, use that laptop to then facilitate a Teams meeting in conjunction with meeting in person. So.
Okay, all right. One issue in my mind is the report, which I now have on the screen. I could see how that could be a challenge to get that to be live on the screen, and yet us having it in paper at the meeting.
And what we typically do, like for formal sessions, we use the virtual meeting platform to then use, so you'd have like this Teams meeting would be broadcast up on the TV. And so you would share the same manner that you're sharing, like if you were 100% virtual. So then you would have the ability to have it on full display in the meeting space. And then everyone who's participating remotely would also see it just like they are right now.
All right. Well, you guys don't all have to be here while I work that out, but But I do think that it might be nice because you could all meet each other. And there's something to be said if you're going to volunteer for something, it's nice to meet the other people who are on the committee with you. I mean, I know each of you personally, but some of you have not met yourselves. Well, you've met yourselves, but you haven't met each other. So, okay, is it anything else? All right, well, we'll see what happens in the next 3 months. I hope it's not as dramatic as the last 3 months. Hopefully we can get things calmed down a little bit and have a great holiday season. All right.
Great. Thank you, Chris.
Thank you.
The meeting is adjourned.
Thank you.
Thanks, everybody.